Good morning, everybody, and welcome back to the Steps to Soul podcast. I'm Brandon Bourgeois, my co-host Chris Sater. Today, we're talking about probably one of the most unsung and unsure topics that people cross today in their selling their business, which is working capital and business sales. So, first off, what is it? Is it included in the acquisition price, and how do we calculate it? So, today, we're going to provide business owners and buyers with a clear understanding of what working capital is, why it matters at different levels of the size of business that you buy, and how it plays into deal structure, especially if it's an asset versus stock sale, and how to avoid these painful surprises down the road, which if you don't get it figured out at the beginning, it's going to be a lot uglier at the end. Chris, welcome. How happy are you about this topic today?
Oh, I love this topic. I've dealt with this topic almost in every, I'd say, mid to large transaction that I've done at some point,
Mm-hmm.
and learned that this is a topic that needs to come up early in the conversation. A lot of buyers don't propose it early in the conversation, but
Mm-hmm.
that's how we protect our clients, our sellers. Is we want to introduce this topic and start, before the offer even comes in or when the offer comes in. It's
Mm-hmm.
not really an offer if this isn't talked about, and so that's, like you said, that's what we're gonna discuss today. Looking forward to it.
Absolutely. There's a lot of context we're going to give here. There's a lot of ways to do this. We're going to kind of cover the basics, kind of give people some insights. It's not a one all fits blueprint, so please don't take this and just copy it verbatim. You need to adjust it, but we're going to give you some insights into kind of how we view it, how both sides are going to view this transaction, buy side and sell side, and kind of how to, like in every deal, it's how to find a proper marriage, right? How to find the right combination to make you feel comfortable and also make pragmatic sense for the deal, because every deal's working capital is going to be different. So just put that in the back of your brain, listeners. But first off, let's talk about the pitfalls of it. Often owners want a price and they think it's just, I give you the book and it's done. Working capital is one of those few parts of the deal where it can fluctuate a lot, especially with a seasonal business, especially with different types of industries. In some business, working capital is not that big a deal. You always need it, but it's not going to kill the business. In other deals, the working capital can decide if a deal is even worth going forward with or not. We'll dive into that some more. But often sellers assume when they do a deal, they're going to keep all the receivables in the cash, right? Typical asset sale. They'll pay out their payables. And buyers also expect in that same deal that, well, the owner's going to leave me cash, right? I deserve working capital. Isn't an asset. How do you categorize it? And that's where it gets kind of murky, right? People's books, because it's not technically a line item on the balance sheet always. So this is where, like we talked about earlier, things do get sticky. So first of all, let's define what working capital is, right, Chris? Pretty simple. It's current assets minus current liabilities. Then you kind of from there you find out that's how much you need to run your operation to sustain consistent cash flow, fund the business. That's basic. What are, current assets? That could be cash or cash equivalents, accounts receivable, inventory, short-term investments, prepaid expenses, liabilities. Pretty simple, standard stuff. Accounts payable, long-term, short-term debt, accrued expenses, and any taxes. So that's the day-to-day stuff. Pretty simple, right? Anything to add there? I mean, we're not trying to get too technical we're not accountants, but I think we're covering the basics, right?
Yeah, well, and we'll get into it more in more granular detail here in a minute. But it's often misunderstood because it's not just one thing. It's
Mm-hmm.
really a measurement, right? You can think of it as your business's breathing room. It's that cushion of liquid assets you have to keep things moving on a day to day basis after you cover
Mm-hmm.
all your your short term obligations. And so,
Mm-hmm.
like you said, it covers all those things you just mentioned. But at the end of the day, it's what's going to keep the business afloat and make sure it doesn't run out of cash if it's run properly.
Correct. And I think a lot of owners never fully understand that number because they don't ever have to calculate it. They get so much into a rhythm of what they pay and their usual expense. They don't think what the working capital is. They may have a number in their head what it is, but few have ever actually sat down on a piece of pen and paper and wrote it out and said, this is my working capital I have to have every single month. Most of them just know, it's around this number. And I always have enough cash in the bank because I've been doing sales for 10 years, so I don't worry about it. But what is it? It's, what is the true operating working capital? AR plus inventory minus AP, and some owners, their working capital might be a little different. You may have where some months it's lower than others due to seasonality. Some may always like to keep a larger reserve, and that number isn't always reflected properly in the documents that we get. And that's so hard to calculate, right? Because you could ask an owner that question. They may not even know where to begin. And so you're saying, okay, let's almost reinvent the wheel for them and help as brokers discover what that number is. Because if we can't identify that number, it's very hard when a deal structure comes in to define it. So let's talk a little bit, dive into a little bit of deal structure, because that's kind of where the working capital gets considered the most important, I think. And we'll talk about Main Street versus lower middle market and mid market deals, because that's where there's a very wide assumption of what's included, right? I think we could both agree that lower middle market, the LLM market, that's when it changes the most, right? That's when the real expectations flip. Would you agree?
Yeah, no, absolutely. And whether or not cash is included, and when I say cash, I mean working capital and all that. But some level of working capital is always expected to transfer unless it's negotiated otherwise in larger
Mm-hmm.
transactions. Smaller transactions, we'll leave those alone for now. We're talking about these ones. Let's draw a line in the sand just for the purpose of this conversation. You could call it 2 million, call it 5 million, whatever you want to do. Somewhere
Mm-hmm.
in that ballpark, working capital is going to be expected because you're buying such a large business that the buyer is going to usually be bringing in cash anyway. The seller is going to
Mm-hmm.
keep his cash, so they're bringing in cash already. But that's usually not even enough to fund the first couple of weeks of payroll and everything else that's going to hit them right off the top. So everything's negotiable, but sellers. That's where we try to educate sellers is like upfront before we even get the business listed. This is what a buyer is going to expect. A professional buyer that understands your industry
Mm-hmm.
and is going to make you a great offer is going to expect working capital. And we can price that into the deal so you're not just leaving accounts receivable and thinking you got nothing, because that's where I often see
Mm-hmm.
sellers get frustrated is like, I've already
Yes.
earned that accounts receivable. I've already worked for all that money. It's just waiting to be, yeah, it's coming in the mail. I've already done all, and that's true. It absolutely is true. But what happens though, if a broker doesn't factor that in early in the deal and tell their client to expect this, then they do feel like they're getting shortchanged and they do feel like they're leaving money behind. But if we've already got the asking price and the valuation done with that in mind, and we've explained that clearly to our client, then
Mm-hmm.
they have a better sense of when they get to the closing table that they're not leaving money behind.
You're not wrong. And I think a lot of times they get that perception because you see a lot of deals, these smaller deals, true Main Street deals, like we said, for the sake of argument, let's say under 2 or under $5 million. They're typically asset sales, right? They're not stock sales. So an asset sale, typically you keep all your cash, all your AR, you pay off all the liabilities, right? And that's considered okay. You don't leave working capital. In a stock sale, as we'll kind of talk about a little bit too, you're taking on the assumption of the AR, the AP, the other liabilities. So you need to have the working capital included because that's how you fund those type of operations. You're not starting a brand new deal. Like an asset sale, you're buying the assets, putting it in typically into another company. In a stock sale, you're assuming the ownership of the stock in that current existing business. So there are technical issues there. But small Main Street deals, let's say a two, three, four, $500,000 deal for quick examples here. When you're buying that company, there's not a lot of working capital needed typically, and that doesn't mean it's not important. Don't take these words and twist them, anybody. But what we're saying is, you may only have a couple $1,000s of working capital that month, and often buyers bring their own cash with those deals. You don't see that with the larger deals. In asset sales, you're not going to include that. Now, can that be included, like we said, negotiated? Sure. But just understand, as a buyer, you're not going to get that cash for free. It's still an asset that needs to be part of the value of the transaction. And most brokers don't value working capital on the smaller deals because of that. Doesn't mean it can't be negotiated or talked about. There's also implications we'll talk a little bit too in stock sale when you get to a little bit larger deals. There's a lot of terminology that goes on. And I think you've got I kind of let you talk a little bit about this more, is the cash-free, debt-free basis, where people do stock sales, but they don't want to have large amounts of AP, large amounts of AR out there. They want the current owner, and like you just mentioned, it's quote unquote their money, to pay down those liabilities, to burn up some of the cash, kind of get it where when I take over the stock sale, I'm not taking a huge amount of debt if I don't have to, right? These cars have been paid off. Other long-term liabilities have been paid off. Maybe not the real estate, but maybe other issues per se. But that also
No,
affects the value as a buyer you're willing to put up, because if you're assuming debt, not going to overcomplicate it here. Cash-free, debt-free is becoming more and more common. But with that, there should at least be some working capital. Maybe a company leaves $1 million in the bank just because they can, but the working capital is maybe only $200,000. The owner's going to be expected he wants to take the $800,000. But as a good broker, you want to position yourself with a $200,000 in cash, that the working capital left behind, right, Chris? You want to at least value that into the total consideration, as we always say.
yeah, absolutely. Even in stock sales, sellers often try to carve out excess cash or make adjustments.
Mm-hmm.
Just because a seller, a business owner has, let's say he has $1 million of cash in the bank account, and let's
Mm-hmm.
say he has excess accounts receivable. Well, first you got to identify why he has excess accounts receivable. That may be a
And what the net
problem with
on
the
those is too,
yeah,
right? Like, is it
exactly. That
net
may be
30,
a problem
60,
with the
90?
business.
That's a huge difference in some industries.
Yeah. So that's typically, and we're going to get into this, but typically we have a formula for just your average ordinary business without seasonality involved. you're going to look back at the past 12 months and say,
Mm-hmm.
look at the 12 months of balance sheets and say, where is accounts receivable every month? And you're going to figure out what that average is for accounts receivable. You're going to do the same thing for accounts payable. And if there's anything else in there that you need to add in to those current
Mm-hmm.
assets, current liabilities, maybe payroll liabilities or other types of assets, a lot of times those are going to be eliminated. And we can talk
Mm-hmm.
about that later. But yeah, you're going to have this trailing 12-month average, and that's how you're going to
Mm-hmm.
calculate the working capital. And if there's excess, that's neat. First you have to figure out why is there excess, and that may be a problem. Like I said, with the business, maybe collections, accounts receivable aren't coming in as
Mm-hmm.
fast as they need to, and that could be the reason. Well, that may be a red flag for a buyer,
Another red
honestly.
flag.
Yeah, exactly. So you're doing all these kind of adjustments and you're figuring out what you're going to leave behind. And honestly, that should have been done in the beginning of the process before you even reached out to buyers and marketed the business. So you can tell your client, I can tell my client, here's what you can expect to leave behind in the sale. And it's going to
Mm-hmm.
change over the course of, the 3 or 4 months. But honestly, if we used a trailing 12-month average, it's not going to change that much. 3 or 4 months getting to the deal, unless we had a economic turmoil or something drastic happen, it's not going to change that much.
I agree. And that's where we talk about all the time, keeping your financials in good working order. This is when this comes in even more as a possible hindrance. Because yes, tracking down cash flow is one thing, right, Chris? But if you can't actually discuss and find out what your working capital is, especially for a larger deal, say lower middle market deal, where it could be $200,000 to $500,000 in working capital needed, and we can't properly adjust because your AR is off or because your bookkeeping system is not properly logging invoices and then throwing them away, where we can't go back and verify, that's massive. And it's really hard for a buyer to say, I feel confident doing a deal, or I need X amount of working capital. Now, ways to work around that if a seller doesn't want to include it, some SBA lenders do allow you to get a loan with working capital with the same 10% down. We'll discuss that a little bit later too. But when you leave that giant hole where it can't be verified or filled, or like you said, trailing 12 months can't be assured or within a very close range, it puts a damper on the deal because the buyer now doesn't know, how am I going to run, on top of having to learn this business, right? Or possibly take it over and assimilate it. I don't know what my actual cash needs are going to be. And anybody's ever owned a business, you don't know how much money to pay the bills. You start getting real twitchy, right? You start panicking a little because you don't know what's going to happen. Can I make payroll? If I don't make payroll, do I lose these employees? As a new owner, the new owner, former buyer buys the business. If I miss payroll, are my guys going to bail on me day one, right? Am I going to lose confidence in my team? So the trickle down effect is important, and it's good to understand why we're asking these questions. And you mentioned a great point. A good broker is going to figure out what those issues are. That's our role, to help figure that number out the best that we can. We're limited what we're provided information wise, but we do a good job of helping you identify that so we structure the deal appropriately. Very often, the one gripe I will say I have with buyers is they come in and just, I expect to get it and it should be larger than it should be. And I don't want to pay for it. You're getting an asset, you should be paying for that asset, right, Chris? It shouldn't just be something considered free just because, in my opinion.
Yeah. Yeah, let's talk about why a lot of business owners don't even know the term working capital, or they know that they've heard the term, but they don't know
Mm-hmm.
what theirs is. And
Mm-hmm.
I've run into this a lot of times. I've run into business owners who have owned their business for 20 or 30 years. They've got instincts, right? They just know what they have to have in the account to make the business run. They know what payroll is going to
Mm-hmm.
be every week or every other week. They know what their bills coming in is. They don't need to have this fancy formula to run their business. They've been doing it for 20, 30 years. Now comes along Mr. Buyer and says, we got to have this formula. We're going to work it this way. I'll tell you a horror story real quick. I had have a business now, where the owner's not even tracking his accounts receivable in QuickBooks. They keep everything in
Mm.
QuickBooks, but for accounts receivable, they were keeping it on a spreadsheet. And they were deleting things when checks would arrive, they were deleting the
No.
payable off the spreadsheet. So we didn't even have a running total for accounts receivable, and they didn't need to. And I kept telling them that that's fine for internal process. I get your process, but this buyer is not going to understand what historical accounts receivable have ever been unless we pull each invoice and start, compiling them again
Double
from
duty.
scratch. Yeah, for the past 3 years. Luckily, we found a workaround, but that was a frightening moment on a very large business, and to think they were doing it, but they didn't need to. They knew what they were making. They knew what their expenses were going to be. They didn't need to know what accounts receivable was 3 months ago. That
Mm-hmm.
wasn't important to them. I mean, it should have been, because that's some management decisions to make about that. But yeah, neither here nor there. I run into that quite a bit, and that's why business owners don't even know what working capital is. They don't know the formula. They don't know why trailing 12-month matters. But that's our jobs as brokers to kind of inform them on the front end and make sure it gets priced into the deal if it needs to be. And that way, it's not sticker shock when buyer comes in and they make them an offer and they are expecting accounts receivable to be included. They never mind when accounts payable is included, right?
No, never. No, but you're not wrong. And let's take it a step further. If you've got a buyer, let's say for a low middle market deal, it's going to be between, let's say, $3 to $4, $5 million, right? SBA is involved. The SBA wants to know what that number is because their fear is this buyer buys his business isn't properly capitalized. This deal is going to collapse and they're going to have egg on their face. So as a seller, you have to realize too, you're also impacting the buyer's ability to get financing to even buy your business. You're hurting the value of your business, not just on the actual value, the number, but the buyer's pool to go get financing to buy it because we can't identify that number. And the SBA is going to want to figure out what working capital is. They're going to want to know. The lenders are going to want to know, how do you fund this business? How do you run it? What is the working capital need to do this deal? And if they can't identify it, you're going to get shot down, right? I mean, be one of the quickest things to say, nope, we can't know what it costs to run this business. Therefore, we will not loan on it. We love the cash flow. We may love the setup of it. But, we had a deal this year, a lawn care deal fall apart because of the working capital at the very end. Now, I think the buyer may have misstated what he had. There's a couple things there that don't add up to me. But the lender cut the working capital at the very end, and the buyer did not feel comfortable with that. You know what the buyer did? The buyer walked the day of closing. So even though you get prepared and the seller made great concessions and was like, look, I'll leave you some AR that I wasn't supposed to leave you, even though this is an asset sale, to cover that if you're concerned. I'll do that in good faith for this deal. It didn't work out. That's how important working capital can be, right? It can literally cause a deal to derail. It's almost just as important when you're negotiating your offer, as you mentioned, to know how you're going to measure the metric. So let's talk a little bit about that, because I think we've kind of hinted around that point on the podcast, but let's dive in there. Typically, you talked about in previous episodes what stages you are before you get an LOI or an offer in place. One of the most important things we've seen lately, you and I discuss all the time, is when these buyers or a buyer submits an LOI. We look immediately, how are they especially if it's a stock sale, right? On a larger deal, how are they going to calculate working capital, right? Is it already defined? Is it not defined? Let's talk about our steps there. Me and you both agree. If the working capital isn't already defined or there's a dispute of it, that LOI has got to have a very short timeline to define what that number is going to be before the process gets further along, correct? What do you think, 60 days at most? 30? Yeah. I prefer 30, really.
Right.
Because if you're starting diligence, we need to know what the working capital is going to be. That can't be figured out the week before closing, right? Because you talk about sellers are going to get upset, buyers are going to be upset, everyone's wasted much time and money. We need to calculate that number early on, because if that's going to change the actual total consideration of the deal, it needs to be figured out early, deciphered, and agreed on how it's going to be measured. What is the quote unquote peg of the working capital going to be, correct? That is, right. I think, a very underrated part of LOIs that a lot of buyers don't even think to throw in there, and they'll just, we'll figure it out later. No. That needs to be early on due diligence, because if you're doing early due diligence, you're going to have the information needed to do that, correct?
Yeah, absolutely. And if you're a seller, a business owner, and a buyer tells you that they're going to figure out working capital like later in the deal, closer to closing, like Brandon's talking about, you need to be leery of that offer, because it's not going to work out in your favor. If that buyer's looking out for himself, he's going to come in I've had buyers who they want it to use industry standard when it works to their advantage. And I've had the ones who say they want it to, yeah. And I've had ones who say they want to use the business as it is, even though the working capital was far in excess of any working capital needed to run that business. It's just the way that owner was running his business. A standard working capital ratio, it's got to be above 1, the ratio number 1.0, right? Because otherwise what's happening is payables are higher than receivables. That's a non-functioning business. It's about to be a liquid. Generally what I find is anything from 1.5 to 2, and that's going to drastically vary based on your industry. It may even need to be higher than 2, but 1.5 to 2 is kind of a safe bet for most businesses in this country. That like I said, that's going to vary heavily on your industry, but that's kind of just to get an idea of what a ratio is on this topic.
No, and that's some great insights there. And for a lot of people, they've as far as they've ever even heard that. And I stress to owners and buyers listening, this doesn't have to be a contentious point. Just know that it takes a little time to get the right number and get the right answer and agree upon it. And let's talk a little bit about seasonality in businesses, because that's where it gets, I think, has been the biggest discussions that we've had. Seasonal businesses, and when we talk seasonal business, not just the working capital, it's also the timing of when the deal is presented and when the closing will be. And I think often buyers, and obviously trying to get the best deal, want to close it right towards the end of seasonality with the highest amount of working capital left over to carry them over into the off season, right, Chris?
Yeah,
You've
exactly.
got to have understanding as a buyer, the owner's not just going to let you close at the last month of the season and take all that money knowing you're not going to need it. You have to have some perspective there. And we've had a couple of deals kind of get messy because of that, right? It's like, if you're offering it and going to be closing before the beginning of the season, that makes a lot of sense. But you also can expect that same owner to have made all, like in manufacturing, produce all these products, spend all this working capital, all this investment, and you doing a stock sale and not get any of the AR and leave all this working capital behind, because that does affect the multiple to the buyer, because now you're getting it for a much cheaper multiple because of all these leftover considerations. That's not really fair to the owner.
In a seasonal business, what's happening is the owner is investing all his cash building up inventory. And
Mm-hmm.
so, on a cash free, debt free deal, the owner's going to walk away with his cash and pay off all debts. But if he spent all his cash on inventory that the buyer's going to get, it could change by millions of dollars, honestly, depending
Yes.
on how much inventory and how much AR they're going to build up that quickly. In a seasonal business, what's the season probably run? 2 to 3 months at most. Sometimes they're
Maybe
1 month.
6 if it's very, very awkward.
Yeah.
You're right.
Yeah, and some things that revolve around the holidays specifically, they could be 1 month, 2 months. So
Mm-hmm.
you've got all this cash. You could be investing millions into AR and inventory and all that, and they're built up high. Your cash is depleted. Maybe you're almost on a line of credit that you use every year to build your business. And
Mm-hmm.
the seller's telling you now you got to pay off your line of credit if you didn't structure the deal correctly, because they're considering that debt rather than a negative current asset, is what I would call
Mm-hmm.
it. It's using the cash beyond excess. But yeah, if the deal's not structured that right way and you've got a very savvy buyer, I'm just going to use that nice word. I'm going to use savvy
Savvy.
instead
Savvy.
of some other words I want to use. If you've got that buyer that's looking to take advantage of a situation, they set the deal for April 30th. They drag their feet and it just drags into June,
Say it's a summer
July,
business too.
August.
You're right.
Yeah.
Yeah.
And now your business starts peaking in September, October, and you're depleted of cash until all these checks come in, but they want to close the deal now. That could be a
Massive
drastic
swing.
change. Yeah, massive swing in the amount of cash and deal value that you walk away with.
My favorite word, total consideration. Favorite words, excuse me, total consideration. And the hardest part to calculate sometimes with some of these seasonal businesses that we deal with is they may make the product in April, right? They manufacture it and they sell it and they provide it, but they don't get a check till September, October because the product hasn't sold elsewhere or it's on lease. If you're talking net 120, 160 days, and that owner's got to stockpile cash in the off season, prepare, build, and so you do have fluctuations. And keep in mind too, the books may look wildly different, the balance sheet, especially from January to June to December because of that. And I think, especially in a stock sale and an asset sale, you're assuming that inventory, right? If that owner has spent a bunch of capital to build that inventory, even if it's not even time to sell it, just building the inventory, there's value there in hard assets and tied up working capital that the buyer has got to have proper consideration when making the offer. And that's where owners have to be. And that's where I'm going to stress this again. Have your books correct and your balance sheet updated properly. So when we come in, we can actually analyze that. The P&Ls give us an idea of how it's moving. The balance sheet tells us the real undercarriage of the house. Is the framework looking good? Is the studs not rotten? And it only so much can be done if we can't, well, we can read what's on the paper. And the paper's wrong, everything projected forward is going to be wrong. And that's where a lot of buyers get frustrated. And I talked to one yesterday down in Florida looking for a lower middle market deal. He's like, I don't want to spend all this time doing a QOV, going through all this work, normalizing all this. I'm like, buddy, but that's just going to happen in Main Street deals. These are not publicly traded companies. You're not going to have Ernst & Young auditing these books. So you just be ready for that. But what I do recommend you do is before you engage a QOV to do due diligence, work with the broker to get some basic numbers already lined up. And if you see things, if you're financial savvy and understand that, question that first. And if you don't get like the answers, don't go forward the QOV. What me and you have discussed, and we recommend this to sellers, if you really want to sell your company and you're a lower middle market level size business, and you've got a lot of fluctuality, whether it's seasonal, a lot of product you're making or selling, a sell side Q of E on a basic level could be a game changer for you because that will clearly identify your AR, AP, proper billing, and your working capital. And then you go to market completely prepared, right, Chris? You can hold the line and work better with buyers. Instead of wasting hours debating these topics, that's already settled. And if you've got bookkeeping issues, we can fix them.
No, absolutely. It's like getting a appraisal on your commercial building. If you own $5 million worth of commercial real estate, but you weren't quite sure what the value was, you wouldn't want to leave $1 million on the table. Same thing for a business. Get a Q of E done. It will show you exactly what your business is doing financially. And from there, we can take those numbers and do a proper valuation. If we're doing a valuation based on numbers that may be one time revenue or things that we just can't see in between the tax return.
Or the bookkeeper fucked up, excuse my language.
Yeah.
Literally just blew out,
Yeah.
messed up completely.
Oh yeah, like deleting AR, like I talked about earlier.
Never
That's
changing
hard.
retained earnings, never updating
Yeah,
it. It just
that's
grows
hard.
every year. Like,
That's hard for us to do. We can still do evaluation on what we see, but a Q of E is kind of taking all that and making sure we see everything that needs to be seen.
that's right. And a good buyer on a bigger deal is going to get a Q of E done. So so just know, Mr. Seller, out and those out there listening, they're going to bring their final projection back, and they're paid a very savvy accountant to come in and do all this work. So they're going to say, look, I went back and got everything readjusted. This is it. So if you haven't thought about it in the beginning, you're going to have to cross that bridge at the end. It's like kind of like these tax deferreds, don't pay taxes for 30 years, but you're leaving that chunk of change for your kids to pay off, right? Same thing when selling your business. If you don't address it now, it's going to bite you at the end. And there may be a few of you out there that have great books and a controller doing an excellent job. You're probably in good shape. But a lot of people listening, we're going to recommend that. And that Q of E will also completely help define working capital from a third party. So you can use it as your leverage. A lot of the sell side Q of Es will also update throughout the year that you're trying to sell if you have new information. So you're getting it's not just, hey, we're pegging something from a year ago or 8 months ago and you got it done in preparation to sell. They'll work with you to update it. So you've got a constant evolving and correcting mechanism. That's awesome. You don't know how much value that is. And it's not that expensive. A lot of services now are not trying to rip people off for 40, 50 grand for small deals. There's some that are very, very, very affordable that the $10,000 you spend on that could save you $100, $200, $300,000 in working capital. That's a 300% return, right, Chris?
Yeah. Yeah, I don't understand why more people aren't open to that. I talk to people all the time. I want to do a valuation for them and update it every quarter. They're just not interested for whatever reason. It's life's happening and they've got a business to run, and I get all that. But
Because they
it's
don't
like,
understand it and it sounds scary.
yeah, exactly, and I guess so. But it seems I'm willing to do this complimentary to help you and make sure that when you are ready to exit, you're in the right position. We're going to maximize what you walk away with. And a lot of people just kind of pass on that. They're just not interested. It's almost like kind of like your last will and testament. A lot of people don't want to get that done because why? Because then they got to think about it, and they just
That's
don't want
right.
to think about it.
And if you do want to think about it and you don't want a Q of E, that is okay. Talk to your CPA and have them help start breaking some of that if your books don't show that properly, or help you calculate that number in advance and make sure your books are representative of what you think it is. It's kind of surprising how often we get involved in deals. We start doing, hey, we need to request these documents. Let me start looking at the numbers. And then I go to CPA and say, I don't know, realize I have that in my books. I don't understand my P&L. It's like, again, we've stressed this in previous episodes, but have your CPA make sure you're not misentering issues. Make sure that line items are making sense. Please eliminate ask the accountant line item, for the love of God. Ask him and get him to change it on your books, please. Because very often that number is going to affect one of the multiple things we have spoken about on today's episode. Talk to your CPA also about your tax implications for stock versus asset sale. We've talked about that previously, and we're not going to try to derail off working capital, but that amount of working capital transferring, leaving could affect your total consideration too in your tax bill. Stock sales are typically more favorable for the seller tax-wise. However, it's still total consideration, what you're getting paid from the deal. Don't let $200,000, $500,000, $800,000 mess up your walkaway because you didn't plan for that appropriately, or you only ever plan to sell your business as an asset sale, but it has to be sold as a stock sale. And how is that going to affect you? Let me talk about the intro coming in. Working capital is often the forgotten topic in deal structure. Everyone wants to find out what the cash flow is, normalized revenues, employee and company structure, licensing, and who your competition is. But that working capital could be that sneaky part in the team. It's kind of like the center of the football team. I'll use this analogy. Nothing starts till the center snaps the ball and bills are paid, right? You can't do anything if you don't have money to start. And if that center goes down hurt, the quarterback, the owner, can't run the company. He can't run if his center's constantly getting hurt, snapping the ball, fumbling it. The buyer wants to know he's buying that strong offensive line for being football's back, baby. Let's bring it in. That center's got to matter. That exchange from the center to the quarterback to the running back or the receiver has to matter. And if the starting point of the working capital can't be agreed upon and you can't agree how to start the game, you got a problem. And for those who don't know, Christopher is a UT alum, so horns down. Go Tigers. We had a great first week. I had to drop that in later in the podcast. Didn't want to embarrass him at the front of the show.
We had a little too much hype at preseason this year.
Just a smidge, right? Just a smidge.
The little expectations were running high based on a name, weren't they?
Yeah, it happens. But it's like anything. It's setting expectations. It's avoiding roadblocks. And we talk about the working capital here. Please, if you're out there listening, working capital is very, very, very important. And if your deal isn't structured cash-free, debt-free, it's going to be even more important because you're going to have a lot more AR and AP to handle, and that buyer really is going to need that. Would you buy a car without the gasoline in the tank, right, Chris? Especially a larger deal. You wouldn't. You expect the dealership to fill it up for you. At least have something there to drive the car home. You know, doesn't mean to give it away for free. Doesn't mean you can't calculate the right number. But you need to, and a good broker should, especially for a lower middle market deal, should be factoring that in. Smaller deals, yeah, you can negotiate that too if you want. It's not as common, but it doesn't mean it's a guarantee. I see a lot of buyers today out there promoting a lot of discussions. Well, it has, you just have to have it. It is unacceptable. It's okay. Look, this is deal making. It's called negotiation. If you're coming in with a hardline stance, expect a hardline response from the seller, right, Chris? It doesn't always come across well in that capacity.
Yeah, I like a buyer I had recently. He's got a freight broker under contract.
Mm-hmm.
We advertised it as a asset sale, $1.5 million. He came in with an offer above asking price, but he immediately told us why. He expects working capital to come into the deal. And he needs that. He wants that because in this particular business, we've got 60 and 90-day accounts receivable and 30-day accounts payable. So
That's
vendors
tough.
want their money fast, right?
Yeah.
And so, yeah, you've got this kind of upside down formula. And I don't think a lot of sellers think about that when they're selling their business and they feel like they're getting gypped out of their AR. Yes, you're going to take cash out of the account, but if you also stripped out all the AR, then that buyer's got to come in not only with cash for immediate payroll, and trust me, they don't want to put enough cash just to cover the first payroll, right? They want several months because they don't know what's going to happen. They're entering uncharted territory for even if they're in the industry. So they've got to have that AR because those checks are coming in. And so that's what I talk about. Price it into the deal, yes, as a seller, but don't get tied to it to where you have to have it. That's not the case. That buyer has to have it. Otherwise, they're going to run out of cash.
You're not wrong. And that's why I told the buyer in Florida I was speaking with. We always train sellers, we're going to put ourselves in the shoes of the buyer to help you understand why we're asking these questions and explaining these scenarios. And I think it's hard for sellers because, well, you represent me. Yeah, we do. But we're trying to help you understand what it's going to take to get a pragmatic deal done. Would you buy a car with no oil, no wiper fluid, and no gas in the tank? You at least want something to get you started. Granted, the buyer should have the means to come in and handle the deal. If they're strapped too thin and they need every single ounce of everything, every part of the deal just totally in their favor, that's probably not a deal you need to do.
That's right.
We're not saying you have to do it, but a good buyer should be capitalized to buy the business. Then should at least have some other capital to work off of to run it in case their working capital runs out or what you leave behind runs out. If a buyer can't complete that end of the deal, but they're capitalized to buy it, you need to think a little bit about that buyer. Doesn't mean they aren't a good fit. Doesn't mean you can't make a deal work, but that's something you need to be prepared for. And as a buyer, if you really want that working capital, make sure it's in your LOI or offer. And if not, to talk to us and the broker and say, how I know it's something I'm going to want. Your buyer made you made a great example of that buyer with the freight brokerage. He went above asking, but I know I want working capital, so I'm throwing that number on the table. I'm sure that number might be a little bit negotiable based on what the working capital is eventually, agreed upon. But that's making the good faith step effort, right, Chris? That's showing a seller, I really want to do this deal, and I'm going to work with you. Not, I'm going to try and outsmart you and show you how wrong you are and why you owe me more money. It's the attitude you take coming into it that matters as well as a buyer. I think that's often under discussed. You're not trying to outsmart the broker and the seller. You're trying to get a deal done. And if your whole approach, I'm just going to try and, like you said, less favorable terms that those other buyers we spoke about tried to use with seasonality of the working capital and taking it as being strategic at that time. If you're just trying to take something like that and get a steal a deal, basically, how much money or investment are you going to lose by not just doing it properly up front, right? Especially when the broker and the seller are working with you to find a compromise and are being pragmatic, and you're just trying to steal it. Don't waste everybody's time, because you're going to go through a lot of problems in deal making doing that, and you're going to be very upset at the end. That felt good to get off my chest. I'm sorry. That was stress.
Want to talk about true ups?
Yeah, let's go for it.
So what is the true up? True ups is going to happen. That's going to happen after the deal closes, right? We've got this working capital. Nobody's sitting there calculating it on the day of closing. We're not looking. Well, I guess you could look at your AR and say, what is it today, and what is it accounts payable? What is it today? Probably should do that. I think people have brought reports to closings and tried to verify that.
Same for inventory. Just calculate inventory at day of close.
Exactly. But what happens is 60, maybe 30, 60 days after, you're going to do a working capital true up. And you're just going to verify that accounts receivable was what you said it was. Have all these checks come in? Which checks have not come in? You told me this was accounts receivable. We agreed on this peg, and this customer never paid this $50,000. He's disputing it. That's the reason for the true up, right? Is to make sure what you said it was is true. It's not uncommon for buyers and sellers to argue months after closing, unfortunately, over $30,000 to $100,000 of working capital shortfall. So I think the best thing to do is to avoid those pitfalls is to start with a clear definition. Start with that peg that we were talking about. Start with accurate data, highly accurate data, and solid representation. Make sure you look at your accounts receivable and the customers that are not going to pay, or maybe they're going to be slow paying.
And identify the good, the bad, and the ugly.
Exactly.
Tell the buyer, hey, these guys are always on time. Sometimes they're late. Sometimes they're real late. Make that clear. That's so important.
Transparency in deal making is golden. If you can be transparent with a buyer and buyer's transparent with the seller, then everybody can kind of agree on the same terms and the fairness of the deal. If you're trying to get one over on somebody, more times than not, I've seen it just come back to bite whoever tried to do that in the ass, right? It may not be at closing. You may get your check at closing, or you may get your deal at closing. But 6 months, a year later, I somehow get phone calls once in a while of this tried to happen, or they didn't want to pay us for inventory. We had signed off on inventory. We had somebody come in and audit inventory. And so it's just these things that the transparency's got to be there when a deal's getting done. Otherwise, it's going to be bad at some point.
Goodwill, it matters. And if you want to be smart and burn it before the deal's there, it's often you're going to blow the deal up before you close, or like you said, after close, there's going to be issues. And it's amazing. Don't try and be smart. Be efficient. Be effective. Be reasonable and be pragmatic. When you do that, your deals often transition quicker. They're a better transition. And the seller and buyer will want to work together post-deal to fix any potential problems. But when you come at it from, I tried to get you and take one over on you, I'm referring to the asset purchase agreement, and that's what we agreed upon, then tough luck. I've seen some sellers be like that. Like, hey, I worked with you and I gave you everything and signed off on the clawback clauses and have it there in the closing attorney. You deal with it. Like, some sellers will take that approach, and they've been burned by a buyer to get through the deal, and vice versa. It's not every deal is warm and fuzzy roses you like for it to be. People have personalities. Other extenuating circumstances come into play, external factors from family and the economy and other issues. That's not an excuse. But it's important to agree upon, like I said, that peg. What is the terms of the peg going to be? How are we going to calculate it? Use great detail to make sure it's clear, and great data. And if you leave an open-ended issue, it's going to remain an open-ended issue, correct, Chris? It needs to be hyper clear. And I think that's where we stressed earlier in the podcast about the LOI. Agree to the terms, how it's going to be calculated, and how quick you're going to find that answer. Not just how is it going to be defined, but how quick. Because you want to get that in writing locked in so that when you go to closing, that's going to be included in the purchase agreements and drafted so there is no confusion, right? Have that ready, especially if there's financing involved. That is so important, and we're going to stress that again. Do not leave yourself open-ended, because it will bite you in the butt on the back end. It just will. You can't be an ostrich and put your head in the sand and hope it goes away. It's going to be a bridge you're going to have to cross. So just cross it early, cross it effectively, and get it done and agreed upon. And it's one less thing on the back of your shoulder you have to deal with towards the end of the deal. And if you're not sure how it affects your deal, give us a call. Talk to your CPA. We can all help you find what the working capital is and how it's going to affect your deal. we talked about in previous episodes, how to prepare your business to sell. This is another factor you want to have lined up before you go to market. And at least if you're not 100% sure, have a good idea what it's going to be, like you said, Chris. 80, 90% correct. That way you're not getting shocked with a major swing in deal structure or value when the time comes to do a deal. Or in the case of your freight brokerage, it's a big positive, right? It turns into a positive because you were proactive. It brought value to you. It gave you value. Man, that was a good one, Chris. I think we covered a lot of good stuff there. I know it wasn't every situation. So those of you out there listening, there are a bunch of minute details we could go into. But what we gave you today was the blueprint and the strategy to use to be prepared. Take it for what it's worth. If you haven't thought about your working capital as an owner, calculate it. My dad told me, always keep 3 months of bills and all this in the account. And this is how much you need to keep in the account. And he stressed that to me every day when he was alive. And I have followed that rule, and I've never had to panic since he passed away unexpectedly in January. I am very thankful someone guided me on that, and with experience was willing to take a step back and say, this is what we need. A lot of businesses haven't done that. We talked about exit planning and preparing for the worst on the previous podcast. This is one of those details you want to have prepared for your family and other parts of your company to run successfully. Chris, I know you do the same thing with your businesses. Please have at least an idea for someone who comes in behind you to run it.
Oh, yeah. Yeah. If you're a business owner, if you're a seller, one of the smartest things you can do, even before you list your business, even now, even if you're just getting started in business, get your working capital house in order, right? And that means
Yes.
cleaning up your AR aging, documenting your inventory, all these things that we talked about today, ensuring your payables are current. Don't pay payables late unless you're just in a cash flow crunch.
And you
Don't pay
have
them
to.
late. Just pay them on time, because what's going to happen is you're going to develop good habits. And then as you get ready to sell your business, a buyer's going to come in and see that payables are paid within the terms that they're due. And what's that going to tell them? It's going to tell them that the vendors that you work with are probably pretty happy with you, and they'll continue to do business with the buyer.
Excellent point.
To check out your working capital. Is it spiking? Is it declining? Why is it doing all that? Buyers are watching for these patterns as well. They want to know what's going on. Why did accounts? I get this question all the time. Why did accounts receivable go from 300,000 to 600,000 and then drop back down to 200,000? They want these answers. So if you've got that, you need to be able to explain it. I'm sure business owners understand that, but kind of get that understanding now as you're running your business, so that when you are ready to sell and working capital comes into play, you've got those answers ready. You understand that aspect of your business, and it's not somebody having to explain that part of your business, because you will leave money on the table if you leave it up to the buyer to negotiate the deal and tell you what working capital is and why you should leave it behind.
And itemize those semi-annual, quarterly expenses that may not always show up as obvious. As an owner, hey, every I got to pay this bill. And you may forget because you don't pay it at 12 every 6 months, but go back and look at your books and say, hey, you know what? Let me itemize these key expenses that might be large or unusual or once a year type deals and break them down. You might be surprised how that might affect your working capital too in those certain months. Like, oh man, I forgot. I got to pay that yearly subscription that cost me a fortune for this, or my semi-annual dues are up for something. Itemize that out. Yes, the 12-month trailing AR, working capital we talked about earlier will include that, but you don't want to sell, not tell that buyer, hey, I got a massive bill that comes up the next week when you take over, and they get in there and that takes up a huge chunk of their working capital they weren't expecting because it wasn't obvious in diligence. Yes, it's their responsibility to find it, but we talked about being transparent, showing that goodwill. That's a very important thing to understand and prepare for, and have lined out and show them, hey, these are the odd expenses we get. So when you're going through the bank statements, you're going through the books, this is why these are random things. My accountant called me yesterday and was like, hey, what was this random purchase for? Perfect. Makes sense. I'll itemize the expense correctly. That's the things that only you as a seller are going to know, or the controller or bookkeeper are going to understand. So you need to get ahead of that.
Yep. Yeah.
That's my final piece of advice for what it's worth.
Talk to your advisor, whether it's your CPA, probably not your bookkeeper, but your CPA will understand this. Talk to them early about working capital. It's not just a detail of a deal. It's one of the most negotiated deal points in M&A, and sometimes it happens too late in the process.
And highly contested too.
Yeah, exactly. So if you need help analyzing or preparing your working capital, please reach out to me, reach out to Brandon. That's what we're here for. No obligation consultation. Set it up. We can help you understand your working capital and how it relates to your deal and your business, and make sure that you don't leave money on the table.
That's right. And if you talk to your CPA, get it done for the last 12 months, 24, 36. Because if your business has been growing, that number has probably fluctuated some. And you need to see what it took invested to grow to where you are now. And when you can show a buyer those numbers, talk about deal confidence, right, Chris? Showing, hey, look, we spent this much, we're able to grow this much. We spent this much in working capital, and investment able to grow this much. That shows a sophisticated, well-run company. And that gives buyers confidence. And the goal at the end of the game is if you want to sell, you want to build as much value as possible and build it to sell. Hence the name of the podcast. And on that note, I think we had an absolute awesome discussion today. I think we covered a lot of great points. For those of you listening, you know how to find us. If not, follow us on Spotify, LinkedIn, YouTube. You can find us at sunbeltnetwork.com. Our office addresses, we are not hard to find, I promise you. And we're happy to speak with you, like Chris said, and guide you. We would much rather guide you now before it's time so that when you can sell, you sell for the best value, but also you're the best presented package for a buyer, so a buyer wants to buy you. It's not just that you're making more money, you're making the company more transferable and attractive. And that's what buyers are willing to pay for. And if they're not, just show them the door. That's okay. And on that note, it has been another great episode, Chris. I hope you have a fantastic weekend. Go Tigers, horns down, and I hope you have an excellent rest of your day.
That's good. Thanks, man.
Always, buddy. Good chatting.